In this week's video, we'll examine the question, did Iraq just throw a monkey wrench into the bullish machine? The proper way to phrase these questions is, how concerned is the market about Iraq at this point, since the market sets asset prices? For the answer, we'll look to the charts. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. The charts will help us stay on task this week by answering the question, have we seen enough deterioration to warrant defensive action in our portfolios? This is a daily chart of the S&P 500 that we've shown on Twitter several times this week. There's nothing particularly alarming here. This is our consolidation period. Here's our bullish breakout. The breakout is still holding. We have price above the 50-day. The slope of the 50-day is up. The market held here, meaning this could act as potential support, as well as this was resistance. This was resistance, so we have relatively strong support in this basic area here, telling us that as long as the S&P 500 stays above 1880, we shouldn't get overly concerned about Iraq. This is a partial screenshot of the CCM correlation model. The correlation model is one of 5 submodels that feeds into the master market model. The correlation model literally answers thousands of questions about the market's risk-reward profile. What these percentages tell us, for the most part, is 80% of the questions or levels are coming back bullish for the S&P 500. If we take the average of the S&P, risk on versus risk off, stocks versus bonds, the NASDAQ, the broader NYSE composite, the triple Qs, which is the technology ETF, and the Dow, the average of these is a still pleasing 88. This is one of the weekly charts, one of many tracked by the CCM market model. This is risk on the S&P 500 relative to risk off, or the fear index. A few weeks ago, we showed that this was resistance for the ratio. The stock market trended sideways and then went down. Resistance, weakness in the stock market. We recently had a bullish breakout, and as you might imagine this week, fear did pick up with the VIX besting the S&P 500 by 12.5% this week. However, we're still holding the breakout, and for the most part, we still have a bullish look here from a moving average perspective. The observable evidence says fear picked up, but not in an extreme way yet. If this ratio breaks down into this level, our concerns would increase, and the CCM market model will begin to check more bearish boxes. We often talk about guideposts or observable evidence. To give you an example of how we use that, this is what a bear market looks like, or maximum fear. The S&P 500 in 2008 price is below the 50-day moving average, below the 200-day moving average. Blue is below red, and the slopes of both are down. It's fairly easy to identify this as a risk-off environment. This is what the S&P 500 looks like as of the close on Friday, June 13th, and you can see it looks much, much better. So something has to change here for our concerns to increase. Friday's article on our blog, Short Takes and/or Seeking Alpha, talks about how we discern between volatility to ignore and volatility to respect. A specific example of using moving averages can be found on this weekly chart of the S&P 500 that we often talk about in these videos. We'll cover this one time and then use it on the remainder of the charts in the video conceptually. This is a full-bore bullish look on the weekly S&P 500. Price is above blue and red. Blue is above red, and the slopes of both are up, telling us that the probability of good things happening has increased. These moving averages help us discern between volatility to ignore and volatility to respect here, where we get a multi-week correction. You can see this looks quite a bit different than this. Full bore bearish look, price below blue and red, blue below red, and the slopes of both are down, telling us that the probability of bad things happening has now increased. Everything we do in the entire market model is based on probabilities rather than predictions. It's much like weather forecasting. We take known information and produce a short-term probabilistic forecast and continue to do that as new information comes in. The whole concept is if you pay attention with meticulous detail, you won't go too far wrong for a long period of time, which helps you avoid big mistakes in investing. The current look of the chart, full bore bullish look. The S&P 500 lost 13 points this week, but this look is not overly concerning as of the close on June 13th. Getting back to our original Iraq theme, how concerned should we be, or more importantly, how concerned does the market look? This is the S&P 500 chart that we've looked at. We're still holding these breakouts. This is risk on versus risk off stocks relative to the aggregate bond ETF, or AGG, consolidation period in the orange box. You can see this is a higher low. This is a bullish breakout. And for now, we're holding the breakout, and we have a full bore bullish look in favor of equities over bonds. As long as this chart continues to look like this, it will check bullish boxes in the CCM market model. Credit markets, JNK, higher yielding bonds relative to more defensive oriented TLT or long-term treasuries, downtrend, bullish breakout. It was down this week, the ratio, but it's still maintaining a full bore bullish look. Nothing here that's overly alarming. Volatility to ignore thus far, volatility to ignore thus far, and volatility to ignore thus far. The market model literally answers thousands of questions about the market. We tend to use more common things in these videos because they're easy to understand and they help us illustrate basic concepts. The 22-week moving average, all things being equal, we prefer to have price be above and the slope be up, telling us that we have a bullish trend. From a momentum perspective and an observable evidence perspective, regular viewers and clients know that when momentum here, Williams percent R, drops out of overbought territory, the probability of bad things happening in the NASDAQ weekly increases. Here it drops out, bad things happen, drops out. This is observable evidence. After it, bad things happen for several weeks. It works in reverse order. The probability of good things happening increases when you move into overbought territory and hold it. Good things happened in the NASDAQ. As of the close on Friday, June 13th, we remain in overbought territory. This looks a lot better than this from a probability perspective. Everything that we just said about the NASDAQ's weekly chart applies to this chart of the S&P 500. Price above a positively sloped 22-week moving average, and our momentum is holding in overbought territory. Something has to change here, which it may, but something has to change for the bears. Daily chart of the Dow Jones Industrial Average from an observable evidence perspective. Resistance finally broke above it, and we're still holding above it. 50-day, 200-day still looks good, still checking bullish boxes in the CCM market model. If your portfolio allocation and strategy remains in buy and hold and hope mode, then this table may provide the motivation to make some changes from a contingency planning perspective. This is 1987. If you went into Black Monday with $5 million in your portfolio on Friday, at the end of the day on the following Monday, you were down below $4 million since the S&P 500 dropped 20% on Black Monday. We're not fear-mongering here. We're just saying it always pays to be prepared. Using our trend-following concepts and volatility to ignore and volatility to respect, IWM Small Cap ETF Weekly, as of the close on Friday, June 13th, is maintaining a full-bore bullish look. It's also still holding above fairly critical intermediate-term support. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shavaco Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.